Hi there, everybody. It's Ifti from Extreme Returns. Today, we're going to be doing a financial analysis on NVIDIA. So, quick background. My name is Ifti. You can call me Ifti. I'm a chartered accountant, qualified in 1995, set up successful businesses. I joined the Etoro platform in May, but they wouldn't let me keep my name of Ifti, so I had to start off all over again. One of the reasons we're doing NVIDIA is because I'm holding a position in it, just under 4%. And if you look at the stats so far, not bad, just under 7% in November, which wasn't quite a full month. December so far is not too bad. So NVIDIA, who are they? Let's have a look. Where are they based? Tell me all about them, Ifti. All right, I'll try my best. So NVIDIA Corporation focuses on personal computer graphics, GPU, graphics processing units, for games, and also, and this is, I think, the most important part, AI, artificial intelligence. It operates through different sectors. Now, it's very interesting because its products, especially the GPU product brands, are aimed at specialized markets. Quadro for designers, GeForce for gamers, Tesla for AI and big data researchers. They've got cloud-based visual computing use as well. So they are also in the process of buying up a company called ARM. It's a UK chip manufacturer, and it produces all of the chips practically. So they're just going through a merger, and they will then have so much more reach and power and growth for their future. I think this company's got a very, very bright future. It's based in Santa Clara, California, lovely part of the world, just outside San Jose, which is Silicon Valley. If you haven't been, why not? Quality-wise, 93 out of 100, according to Stockopedia. Please do look at Stockopedia. Fantastic resource. I can't recommend them highly enough. As an accountant, it really makes my life a lot easier. So what do I look for in quality? Well, quality mainly is metrics like return on capital employed. Now, that's how well the company is reinvesting capital to make more money. 17% is good. I mean, we've seen Apple at 30%, we've seen Google at 13%, we've seen Amazon at 11%, but 17 is not bad. Operating margin, which is another metric, which is really important. That means the costs, beg your pardon, the revenue minus the operating costs. Operating costs are those day-to-day costs which are involved in the production of a service or a good. And we're going to have a look at that in just one more moment, but the margin is 27%, very, very good. Microsoft was 38, but it's a very different company. Amazon, I think, was around 6%. So this gives you an indication, although you can't compare, like, they're not obviously the same in terms of sectors, but in terms of the amount of margin they're making, it's really important that you do compare. So revenue. Now, this company's been on a massive streak of success in terms of growing their revenue. So it was at 4.7 billion back in 2015, grew to 5 billion, nearly 7, 9.7, 11.7, dipped in 2020, but the 12 months, the last 12 months basis. Now, American companies have to give quarterly updates. So you take the latest update and the last 4 updates. And that's coming in at 14.8 billion. Then they give their estimates for the next 2 years as well. So in this case, it's 16.4 and just under 20 billion. Compound annual growth rate, which is what CAGR means, 18.5%. That is fantastic. That really, really is good. And importantly, if you look at how profitable it is, it went from $631 million static, then more than doubled the year after that, and then doubled again, which is just fantastic. It's really difficult to double profits 2 years in a row. Increased profits substantially the next year, took a dip. Now, that'd be interesting to know why they dipped so much. I'm not quite sure. I'd have to do a bit more research into that. But that's one question I would ask. Their revenues dipped and their profit dipped. But having said that, they've recovered. And next year, they're looking to increase it substantially, and the year after as well. So if you look at the compound annual growth rate, it's 35%. Compare it with revenue, which is 18%. It's nearly double. So what that means is that for every dollar of revenue it brings in, and any extra dollar of revenue it brings in, the rate of return in terms of profit is nearly double. What you often see is companies growing very fast, but that revenue is not being translated to the bottom line. Here it is, and I haven't yet come across any company that's getting substantially higher growth rates in their profit compared to their revenue. So this is a very, very profitable company. And then you can tell by a number of things. I would look at cash. So they were sitting on 4.6 billion back in 2015. Now they're sitting on a cash pile which is greater. It's 10 billion. Do they give a dividend? Yes, a very, very small one. 0.13% is peanuts. Now, if you compare, now let me see if I can do this. So if you look at the S&P, the dividend yield is 2.1%, and the PE ratio is 20.9. Compare that with a lot of the tech companies. Let's go back to NVIDIA. Its dividend yield is only 0.13%. So what that tells me is that in the S&P 500, which is the 500 largest listed companies in America, the dividends are largely coming from non-tech companies. So it seems strange to me that the companies that aren't making the bulk of profits in America are the ones paying the highest level of dividends, and the ones that are sitting on huge cash piles. I mean, 10 billion does sound like a lot. I wouldn't mind it. But compared to, say, companies like Google that have got 130 billion, Apple that are sitting over 100 billion, Amazon sitting on a cash pile as well. If you count their cash piles, it's huge. So they should be giving some of it back. Anyway, enough about that rant. I go on about that with every US tech company. Now, in terms of value, it's very poor at 5. How do we know that? Look, PE ratio is 46. What does PE ratio mean? Have a look at some of my other videos, but it's price earnings ratio, the most widely used metric. I don't think it's the most important one, but it's a good place to start. The more expensive it is, 46, the higher it is, the more expensive it is. So the Nasdaq is trading at about 32, 33, and if you look at the S&P 500, it's 20.1. I'm going to give you a comparison. The FTSE All Shares at 16. Hang Seng is at 10.7. The Nikkei is at 16. So what does that mean? It means that if you've got a PE ratio of 46, it's very expensive. Now, PEG ratio is taking into account growth estimates going forward. And what that tells me is that it's very, very pricey. I wouldn't get into this stock now. Look, pre-pandemic levels, it was at 250. It's more than doubled now. It's 530. In fact, it went up to 566 here. 573, in fact, nearly 574. It's been going down since then. I wonder why. Is there anything in the news about this? We would have to look back in those times. NVIDIA announces upcoming events for financial community. This is just going to be general stuff. Anyway, that's one question I would dig into a bit more deeper. And if you look at its share price now, look at this. Back in 2001, it was trading at less than 14. So if anyone had recognized the potential then, and it, to be fair, it didn't do anything much for many, many, many years. I'd say until this point, 2017. Like a lot of the other companies, if you look at Apple share price, if you look at NVIDIA share price, a lot of them, Tesla didn't even take off until early this year. It became exponential. Now here, obviously, it took a big dip, 2018, and another dip here in March. But, and this is one thing I tell a lot of my copyiers, don't worry if it dips. All share prices dip. It's natural. Now, one interesting thing is, who are the shareholders now? Their CEO is a really interesting guy. Now, Miyoshi-san, who's the founder of SoftBank, has called this guy the next Steve Jobs. I can't pronounce this guy's name. Yen Xion Huang. He owns 3.46% of a company that's worth 243 billion. So he's a multi-billionaire. In terms of momentum, let's look at that. It's trailing the market by 5% over the last month in terms of its share performance. But if you look over a wider timescale, 1 year, for example, it's outperforming the market by 95%, which is brilliant. It's off its 52-week high. We've seen that. It's moving average over the last 50 days, which means the average of the share price in the last 50 days compared to what it is now, it's going down. The moving average is going down. However, on a longer term basis, to 200 days, it's much higher. So that is my analysis of NVIDIA. It's a very good quality stock, low, but it's very pricey at the moment, but it's got good momentum. This is a company I think a lot of people should have in their portfolio. And that's why I've got it in mine here. I've got a holding of just under 4%. Please do check out my other content on extreme returns on YouTube. Like, subscribe, share. I really appreciate it. I'm part of the Popular Investor Program. If you have got an extra £160 sitting in your Etoro account, I'm sure you do, please copy me. I'm trying to build up my portfolio, trying to build up my ratings as well. So anything you can do to help would be hugely appreciated. Thank you so much. I hope you've enjoyed this video. See you guys very soon. Take care and bye.